Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell, and welcome to the Build Wealth Canada podcast. In this episode, my goal was to really make it relevant for both types of listeners. First, those that are just getting started in do-it-yourself investing or are looking to transition to becoming passive index investors instead of trying to beat the market by stock picking or owning expensive, actively managed funds. We're going to try to build a strong foundation for you here to help you get started, such as discussing what it actually means to be a total market index investor, what the research says about passive index investing versus actively trying to pick the investments that are going to beat the market. And we talk about the different ways that you can be a DIY passive index investor here in Canada and the pros and cons of each. Next, we're going to tackle something that's a bit more intermediate level and something that I've personally been deliberating and have been curious about for quite some time. And that is when it comes to the more stable fixed income portion of our investment portfolio, the bond portion as many would call it, what are some of the options available to us here in Canada? And what are the pros and cons of each? Now, we've all heard of high interest savings accounts, GICs, and many of us have heard about the all-in-one bond ETFs that capture the aggregate bond index and have an assortment of bond types in them. But what if we only want a specific type of bonds in our portfolio because of the degree of volatility and income that it produces? What are these different types of bond ETFs that we can buy? And what's the trade-off that we incur by choosing one over another? Now, the reason that I really wanted to tackle this subject and why I think it's relevant to you too is that traditionally, stocks and bonds are seen to have an inverse relationship to each other. When stocks go down, investors expect bonds in their portfolio to go up. And when bonds go down, investors expect stocks in their portfolio to go up. But back in 2022, during the COVID era, something interesting happened in that both stocks and bonds went down. And to make matters worse, the aggregate bond index didn't just go down by a little bit, it actually went down by 11.48% in terms of total returns, according to Morningstar. Now, this was a very big deal for many investors because the bond portion of one's portfolio was historically seen as the safer, less volatile portion of our portfolio. And so when this safe portion of your portfolio falls by over 10%, that sets off a bunch of worry by investors because the asset that you thought wasn't going to fluctuate much is all of a sudden incurring a 10% drop, which many would perceive as pretty volatile. In other words, the thing that we thought was a safe haven was temporarily not behaving like a safe haven in the way that many of us were expecting it to when we first bought that investment. Hence, investors worrying and even panicking during this time. Now, stocks fluctuated a lot more during this time, but still, people just were not used to seeing something like a 10% or higher drop in their bond holdings. So after that experience, if owning the aggregate bond index is seen as something that is of higher volatility than what you're maybe comfortable with, then what if instead, for that bond portion of your portfolio, you bought bond ETFs that hold a specific type of bond that has even less volatility than the traditional aggregate bond ETF? Now, I'm not saying that you definitely should or shouldn't buy the traditional aggregate bond ETF. Many investors, that is actually the best choice for them. But I do think that there is value in you and I knowing the different types of bond ETFs that exist so that you can choose the one that's the best fit for you. And so in this episode, I invited Aaron Allen back onto the show to teach us what other ETF bond types are available to us as Canadians for the bond or fixed income portion of our portfolio. Aaron is from BMO ETFs, and they actually construct some of the most widely held ETFs in Canada. So this way, we're getting our information right from the source, and I was hoping she could teach us what the differences are so that we can all better choose the bond ETFs that are the best fit for us and our risk tolerance so that we aren't surprised or panicking the next time a similar crash like this happens. Now, they have both the aggregate bond index ETF. They also have the ones with the individual different types of bond ETFs as well. So they have that entire assortment. And so we're not trying to convince you to buy one versus the other. This is very much more so to just take a look at what is available out there. How are they constructed? What can you expect from each? And then this way, you're able to pick and choose the type that is the best fit for you. All right, so that's going to be part 2 of the interview. But first, let's get into that first part, which is the foundation for do-it-yourself index investors, as we mentioned earlier. And then we'll dive into this more intermediate level topic when trying to fine-tune that bond portion of your portfolio. All right, Erin, welcome back to the show.
Hey, Cornell. Thanks for having me.
Good to have you back. To kick things off, before we get into the details on the different ways that us Canadians can structure our portfolios, just to be beginner friendly as well, can you take us through what it means to be a total market index investor versus some of the other investing styles? And why do investors like myself and many of those listening use ETFs to invest in this way?
Yeah, great question to kick things off with. We hear about being a total market investor all the time. And as a total market index investor, it really means you're just looking to own a small piece of everything in a nutshell. So the goal is thousands of companies across different countries and industries and even market cap sizes. And as you said, it's generally done through ETFs. They're low cost, often based off of indexes. But there are also mutual funds that can deliver this approach as well. So yeah, it's all about not trying to pick the winning stocks and not trying to time the market. You're investing in the entire market and you're just letting it grow over time because we know that over time, generally speaking, the market's going to go up. So it's really this passive long-term approach that's backed by a ton of research. And it's one of the easiest ways that Canadians can start investing because there's, at the end of the day, not a lot of thought that goes into it when you're a total market investor. So we're going to get into asset allocation ETFs today. And this is really where I think these things have really taken off because Canadians are not necessarily looking to spend a lot of time on their investments and looking to be globally diversified. And these all-in-one ETFs really are a good tool to give you that diversified mix of global stocks and bonds. So they've become a favorite. I know they're a favorite of yours too. And they definitely simplify that total market investing approach and that broad diversification that everybody's looking for these days.
For sure. I literally use them exclusively in my investment portfolio now. That's literally all we own. In addition to having some cash cushion and like a high interest savings account just for some monthly cash flow expenses, that kind of thing. Yeah. That's literally where all the money is. I'm a big fan. Anybody new to the show or anybody that's been listening to the show for a while already knows this. But I thought too, there's different kind of nuances and different ways to fine tune things for your situation. Also depending on what stage you're at, whether you're in the accumulation phase or decumulation. So I thought it'd be fun to dive into that. And since you know the ETFs in so much depth, it'll be fun to pick your brain as well, just so that we can better choose which one is the right one for us. Because there are certain nuances, obviously, between the different ETFs. And I figure the more we know about them, the better we can choose which ones are right for our particular situation. Using ETFs to be a total market index investor is something, like you mentioned, that has been researched quite heavily for some time now. It's not some brand new thing anymore where it's untested. There's very much a lot of historical data and studies done on this. And there's been so much growth in it as well, right? That it's been very much in the spotlight. Meanwhile, many of us are constantly pitched certain get-rich-quick strategies or investments that claim to offer only upside at literally no added risk, which obviously is a big red flag, but we get pitches like this all the time. Can you take us through what the research actually says and why you and the team, myself, and so many listeners of the show have decided to invest so heavily into this type of investing?
Yeah, there is a lot of research on the topic. And I think if we rewind a long time ago, one of the most famous studies comes from Nobel Prize winner Eugene Fama and Kenneth French, so the Fama and French study. And their research really showed that it's, again, incredibly hard to consistently beat the market by picking individual stocks and trying to time when to buy and sell. And they pointed out that a lot of professional fund managers underperform the market over the long term. I think more recent study that I like to point to is the Spiva research. And I know that you've been interested in this past. You've had Joseph from S&P on. He's a great speaker on the topic. But this research has been going for over 20 years now. And it stands for S&P Indexes versus Active. And it's a regular semi-annually, they put out this report that shows how actively managed funds across different categories are performing relative to their benchmark indexes. And it's really transparent and you can't really ignore the numbers. And the key takeaway is that, newsflash, most active managers, those who are really trying to provide alpha, that's why people choose an active manager, are not outperforming their indexes. And even if they manage to do it over a 1-year period, the persistence scorecard is what S&P calls it, shows that the likelihood of them being able to do that year over year is even smaller. Just to throw a number out there from the latest study at the time of this recording, over a 10-year period, more than 80% of US large cap active funds failed to beat the S&P 500. And that's one of the more conservative numbers. If you look across some of the other categories, that number even goes up even higher. This is just very transparent, very long-term research that supports the total market approach to investing that you can Google and see on a semi-annual basis. It's really helpful for investors.
For sure. Yeah. Anybody that wants to look it up is just SPIVA. If you put that in, and I think Canada at the end, because there's ones that they do specifically for a Canadian audience as well, you'll be able to see that and they keep updating it. And then I think that's such a good insight that they provide, especially when you mention the persistence scorecard, because from what I've seen, sometimes people that play the whole active game, they'll say, oh, look how good it did last year. Don't you want to join this year? And then that's a common sales pitch, at least from what I've seen. Whereas the more important question is, you're not investing for a year, you're investing for most people for decades. And so you're very much concerned about how it has actually performed over time. And then the ones that don't perform get eliminated as well. So it's like you have this sort of survivorship bias as well, which is a whole nother thing to get into. So yeah, for sure. And yeah, if anybody wants to hear that last episode that we did, Aaron, I believe you were in that one as well. We did it like the three of us, which was really fun. You can just search Build Wealth Canada space SPIVA, and then you'll get to see that interview. And yeah, it's a really good educational piece on that particular component. So when someone decides that they want to be a total market index investor, one of the first dilemmas that inevitably comes up is whether they should buy an all-in-one ETF, like a ZEQT, for example. That's one of the ones I buy quite a bit of, or like a ZGRO as another example, or whether they should buy the underlying ETFs that make up those all-in-one ETFs to potentially save a bit in fees and potentially gain some tax optimization, assuming you'd actually pull all that off correctly. Can you speak to the pros and cons of each of these approaches, and approximately how much can an investor save in fees by buying the underlying ETFs versus opting for that massive convenience that asset allocation ETFs bring to the table?
Yeah, you said it. There's really two ways to approach it. You can just use the asset allocation as a model and go out and, buy the underlying, maybe supplement certain ETFs if you want to add different approaches or different issuers. So there's the ability to do it yourself. But the asset allocation ETF, the pro is really the simplicity, that one ticket solution, the fully globally diversified. The other big benefit is the automatic rebalancing. And I don't think we think enough about this, how much time and energy and that rebalancing decision takes people on a whatever it is quarterly basis to do, and the cost of trading those ETFs. Having the fund do that for you also helps you get past some of these emotional biases that a lot of investors have. And you could spend a lot of time talking about all those common pitfalls that investors have. Recency bias, becoming attached to some of their holdings, home country bias, all these things that get in the way of doing what we know we're supposed to do. The asset allocation ETF basically helps mitigate a lot of those things. And I mentioned the time saving. They're also very beginner friendly. I think they're a good entry point to investing. I don't think they're just for beginner investors, but yeah, what a simple way to get started for new investors. On the flip side, they do have slightly higher fees. So you're going to pay a premium for all this convenience. I think it's a very fair premium. So maybe this is a good point in the show to announce that we just did a fee cut on our asset allocation ETFs, on our flagship asset allocation ETFs to 15 basis points. So it is a 3 basis point cut. It's making us amongst the lowest in the space. There's a lot of competition in this space, but I think it just shows that we're continuing to try to improve these and give more access to investors. So I guess if you take this $100,000 investment into ZEQT or BMO All Equity ETF, for example, and assume a 17 basis point all-in MER based on the new fee reduction, you're looking at $170 per year. Whereas if you were to do it yourself, I'm going to make a couple assumptions here, but let's say you're buying all the underlying and the average management fee is somewhere around, or the average MER is somewhere at 7 basis points, you're going to be paying $70 a year. So potential savings, $100 a year. But again, let's think about the extra value that you're getting from the asset allocation ETF, the time you're saving, the rebalancing that's hard to do for investors. I personally think it's well worth that added cost. But it's going to come down to how much energy you really want to put it towards your investments, which is when we get older and we start having kids and stuff, that time becomes more precious.
For sure. And for anybody that is curious how, if you want to buy the underlying ETFs, how do you actually go about doing that? One way you could do it, for example, is we'll use ZEQT as an example, which is the all equity ETF. You can just Google ZEQT, go on the official site, and then there'll be a tab where it says holdings. And when you click on holdings, you'll see everything that ZEQT in this example holds. And you can do this for other ETFs too. This isn't just like a ZEQT specific one. I'm just using that as an example. So you Google the ETF, you go to the provider's website, you see what the holdings are in the holdings tab. And then there you can see the weights of each one. And so then you can basically say, okay, instead of just buying, in this example, ZEQT, I'm going to buy those ETFs that are part of that ETF. And how much do I buy of each one? It shows you the percentage there in the weights. And basically all of those will add up to 100%. So then you can actually craft essentially like your own asset allocation ETF in a sense. You're literally at that point holding everything they're holding. And Aaron said you do pay a bit less in fees if you do it that way. And if you want to go down the rabbit hole of tax optimization, like if you have your TFSAs, RSPs are maxed out, you're now registered in your non-registered account, maybe you have a corporation too where you can invest, right? So you get into these tax optimization where you're taxed differently depending which account it's in. And so there's all these different things that you can do in that case. But as you can imagine, the complexity at this point rises quite substantially. And it is a fair bit more work to, one, learn everything when it comes to that. Two, to actually rebalance as well, because now you're no longer getting this automatic rebalancing. And so what I typically tell listeners of the show that ask me this question is, if your portfolio is, let's say it's a few $100,000 and not even more than that, I would say don't even bother with it, because you really only start to gain benefits of these little optimizations once your portfolio starts getting really large. When it's small, and by small, like I said, I mean like a few $100,000, I would say it's not really worth your time, because the hours you're going to have to invest to learn this and rebalance yourself manually with a spreadsheet is just not, you're probably making way more at your job than playing with a spreadsheet on a Saturday night trying to figure out, okay, I got to buy this many units of this, sell that many units of that. So I did want to point that out in case someone is like, how do you actually do this underlying ETF thing? So that is an option. But like Aaron said, there's pros and cons. One thing that I wanted to get your thoughts on as well, Aaron, is one thing I've been thinking about a little bit is a hybrid approach in a sense, where you're using asset allocation ETFs, but now like we were talking about ZEQT, which is 100% equities. And then the other asset allocation ETFs you guys have and a lot of providers have, it's like a mix of stocks and bonds. So I just want to get your thoughts on this. One thing that I've been telling some people who want to do some tax optimization, but they also don't want to buy the underlying because that is quite a bit of work, like we just said. So one of the sort of tactics that I've been suggesting was for something like your TFSA, you can hold something like ZEQT, which is basically hold an all equity asset allocation ETF, where there's no bonds in there, just equities, because equities long-term have a higher expected return. And so it makes sense to put those types of investments in a TFSA, because in a TFSA in Canada here, any gains that you get on that, you can then withdraw tax-free. Yeah. So it's, if you have this investment that has the highest probability of growing the most, why wouldn't you want to put that in the account where all that growth is going to be tax exempt? And then, for example, but then you might be like, I don't want to be all stocks because that's too risky for me, which is fair. And that is probably the case for most people. So then you can take a different asset allocation ETF, like a ZGRO or one of the ones that have some bonds in it as well, and put that in, let's say, your RRSP. So now that one has some stocks and some bonds, but your TFSA is basically optimized for maximum potential growth. You're not dragging it down with the lower expected returns of the bonds. What do you think of this approach? If you're still using asset allocation ETFs, but you're putting the different ones in the right accounts
asset
to
location,
try to save some money.
Asset location using asset allocation ETFs. No, I like it. I think it could make sense for people for sure. I've also heard of, because we talk about how maybe you're all equity, maybe you're 30 years old and you got a long time horizon and you're in the all equity ZEQT portfolio. And we always say, make sure you're revisiting your asset allocation. And over time, your situation, you might need to add fixed income as you approach retirement and this type of thing. And a lot of people are like, I don't want to sell my ZEQT that has all these gains at that point and then have to put it into ZBAL to get more conservative. So something that you can do there too is just add the more conservative option, right? Don't
Yeah.
sell your ZEQT and buy ZBAL, maybe add ZCon in a portion to even out your asset mix. So there's different ways you can use them for sure. You can get creative.
Yeah, that's a really good point, especially if you invest in a non-registered account. Let's say your TFSAs are maxed out, your
Right.
RSPs maxed out, and that you still want to invest because let's say you want to retire early. So, okay, you're probably going to have to invest in your non-registered accounts, your taxable accounts. But yeah, so like you said, if you've got all these equities in there, if you start selling them off because you want to switch to something more conservative, you're going to you're going to get a little bit of a tax hit, right, on those capital gains. And so you could say, okay, maybe I'm not going to sell them, but maybe when I get my paycheck now every 2 weeks, I'm going to just put those into a bond ETF and put that in like a different account, like the RSP, for example, something like that, and actually not touch the equities because I don't want to get taxed for that particular year because you may still be in a high tax bracket. That's a really interesting point. Yeah, because I could see that people be like, what if things change? I don't want to all of a sudden sell like 500,000 of ZEQT because I want to jump into like ZGrow or something like that, right? So,
yeah, and thinking about it from a sequence of return risk things. So like, where are you going to begin drawing your income first in retirement?
Right.
And think about putting maybe the portfolio with more fixed income there to avoid that sequence of return risk of seeing a big market drop right when you're trying to pull out your funds.
That's right. Yeah, for sure. If anybody wants to learn more about this, because we're getting into kind of the nitty gritty of how different investments are taxed differently in different accounts. And so if somebody wants to optimize that, I do have a whole document I wrote that goes into what is most tax efficient in what account, like RSP versus TFSA versus non-registered.
Yeah.
So I'll share that with people as well. It's buildwealthcanada.ca/guide. If you go there, it's basically a Google Doc that I update, and it goes into what my portfolio is, but also I explain why I put, because I do buy underlying ETFs as well. And so it goes into detail why I chose this one for that account and that one for that account. So if somebody wants to optimize in that way, at least now they have a resource that they can use. So awesome. Thanks. And yeah, that's a really good insight. I appreciate you bringing that up because like it's nobody wants to all of a sudden sell hundreds of thousands of an ETF just because they're like, okay, I guess I'm older now. I want a little bit more fixed income. And now a quick message from one of our sponsors.
It's the small things that make us Canadian. At BMO ETFs, all of our tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we know how to build solutions for the Canadian investor. So the next time you invest in ETFs, consider a Z instead. Visit BMOETFs.com for more.
The other major dilemma that investors face when constructing or evaluating their portfolio is what mix of stocks versus fixed income they should use, so the asset allocation. Personally, I have found this dilemma to not just be a challenge that new investors face, as I've been investing for decades at this point, and I'm still often deliberating on whether I'm leaving too much money on the table by having too much in that fixed income category, whether it's bonds or high interest savings account or GICs. What are some of the best tools or resources or just ways of thinking that you feel can help an investor figure this out?
First of all, same, Cornell, same. Such a relatable, keeping you up at night kind of question.
It never stops, eh? Yeah, I know what you mean.
Yeah, I think there are some tools out there like investor questionnaires, investor profile questionnaires you can use to get some clarity around these things. I think there's a couple ways of thinking about asset allocation. One would be like your risk tolerance versus your risk capacity. So risk tolerance is like how much volatility you're emotionally comfortable with, as you mentioned. And then risk capacity is how much risk you can actually afford to still meet your goals, to take on to still meet your goals. Time horizon is another one. So if you have a longer time horizon, of course, you can have less fixed income in your portfolio. If you're decades away from needing that money, short-term dips aren't going to matter as much and you can take on more risk. And then, as you say, and I think this one affects me the most, the sleep at night factor, your emotions. So if a 20% drop in your portfolio is going to cause you to panic sell, you probably need to add that sort of behavioral buffer in there, even if it means giving up some growth, because we all know that it's so important to stay invested over the long run. But I also feel like fixed income has a bad name, and people often look at it as leaving money on the table. Maybe, I don't know if that's just our generation, but I feel like people are just like, oh, fixed income. I'm like, no, think of it more as like an insurance in your portfolio that's going to help you stay invested in equities during tough times. I think that's a better way of looking at it than leaving money on the table, because there's so much more that goes into that decision. But yeah, there's an BMO investor profile. There's also BMO's Smartfolio risk assessment tool that's really good. It helps you determine your appropriate asset mix. Great place to start, but I don't think there's a perfect mix, just one that's going to help you stay invested and sleep at night. Even seasoned investors like you, Cornell, are going to be kept up at night. But I think this is the beauty of the asset allocation ETFs, is that it's very transparent in the asset mix that you're getting, and you can really target the one that you feel most comfortable in.
Yeah, I find for me, it's more the opportunity cost I keep thinking about.
Yeah.
Or it's, how much could I have made if it wasn't, which I guess is a good thing to think about at night, or better, as opposed to, I think I'm going to sell. Like, this is crazy. I can't handle it. And then panic selling.
When
and
the markets are closed.
When the markets are closed and then when markets are at the bottom, that kind of a thing. So I guess a relatively better problem to have, but still, yeah, you could spend all this time optimizing your investments. And then that one time you panic sell, and it's like all that work you did was almost for nothing because you just solidified your losses during a temporary market hiccup.
Yeah.
Just going back, and again, to be friendly to the beginner investors as well, for anybody new to the all-in-one asset allocation ETFs, can you briefly explain how it all works in regard to finding your asset allocation and then selecting the correct asset allocation ETF based on that?
Yeah. So assuming you've done the whole risk profile questionnaire, or you've talked to an advisor and you've figured out, okay, I should be 80-20 or whatever it is, then yeah, you would go to BMO ETF's website, where you'll find there's a landing page on asset allocation ETFs. It shows you exactly what we have. So we have the all equity, 100% equity portfolio. Then we have an 80-20, a 60-40, and an 80-20 on the other side with 80% fixed income, 20% equity. All the portfolios are there. Those are sort of the four flagship. We have launched a couple more innovative solutions over time. We have an ESG portfolio, ZESG, for those who want to align their values with their investments, and that's a balanced 60-40 asset mix. And then we've also launched an income-focused one, ZMI, where the underlying is dividend-based ETFs and covered call-based ETFs. So there are a couple more innovative solutions, but the plain, I would say, vanilla asset allocation ETFs are ZCon, ZBAL, ZGRO, and ZEQT. And you're basically going to, think about how much equity you can afford in there. The equities are that growth engine in your portfolio. They're going to be more volatile over the short term, but they're going to give you that higher return potential over the long run. And I think the best route is to either do a questionnaire or talk to an actual advisor and figure out where you lie. But from there, it's really simple to pick a portfolio. Look, as you said, go and look at the underlying ETFs and really get down to what the underlying holdings are and what geographies you're getting exposure to, and compare it against what the competitors are doing out there in the asset allocation ETF space. BMO ETFs recently launched a great comparison tool where you can put up ZEQT versus all the other all equity asset allocation ETFs, and you'll see the fee, you'll see the performance, the geographic breakdown, because you got to find what's right for you.
Awesome. Yeah, I can definitely look onto those. I think that'll be very helpful for people. I think too, I think this is going to be a bit more maybe for the sort of intermediate people that have already been doing this for a bit. One other option too that I was thinking about, again, going back to this hybrid approach, is you could get an all equity asset allocation ETF, and then for the bond, so like a ZEQT, for example, but then for the bond portion, you could choose what kind of fixed income ETF you'd like based on your preferences. And I know we're going to get to that later in the questions, because that's one thing that I've been spending a very disproportionate amount of time on, just deliberating, because there's short-term bonds, long-term bonds, ultra short-term, there's money market, there's all these different types of fixed income. They behave differently. And I remember over 10 years ago now, when I first started in all of this, it's felt simpler, at least when you read the blogs and everything, because everyone would pretty much just say, just get ZAG. Always get, like for the bond portion, just get ZAG, and then you're done for that fixed income piece. But then I think what was interesting, and I think investors' thoughts on this maybe changed, or for some investors it changed, is that we had bonds fall because of the change in the interest rates, and we also had equities fall. And so I remember there was quite a few investors that I spoke to where they were like, some family even, the retired family members, where they're like, Cornell, what's going on here? Bonds are supposed to be the safe portion of my portfolio, that when stocks go down, my bonds go up. And here I'm seeing my bonds have actually fallen double digits because of the changes in the interest rates, which isn't like the bond provider's fault. It's just that was the nature of the market. And stocks have also fallen. So what am I to use here as my safety bucket? And so that I would say for me, and me too, when I look at that, I say, okay, I used to use this one safety bucket by just getting this broad bond exposure. But now maybe I'm not comfortable with that because after seeing bonds fall double digits, some people will be thinking, okay, maybe I should do something shorter term. Maybe I should have a portion in a money market ETF, right? Like a ZMMK, for example, where, okay, maybe over the long run, I don't expect as high of interest payments. But when we have another scenario, at least I know that I'm not going to be in the negatives and I can use that when I'm retired to pay for my groceries and not have to really sell anything at a loss. So I definitely think that's an interesting thing I will get into it later, but like where you could take a ZEQT and then because the other ones have the bonds included, but you could buy those bond ETFs individually based on which one you want. So we'll get into that, but I think that is something that's you've seen happen or just from conversations that you've had.
Yeah, I think fixed income and equity has become more correlated. I think that was obvious in that situation, but I don't think that's going to happen in all situations. There's still a place for it, I believe, in a portfolio, but you're right. Yeah. If you don't want to just have broad fixed income exposure and you want to make it even more conservative, you could go ultra short term and sleep at night. So yeah, I think ETFs are my favorite invention in the fixed income space. When I started in the business like 17 years ago, I didn't know what it took to invest in a bond, but then I started to quickly learn, you have to go online and sort through hundreds of bonds and you can only buy like one bond if you have X amount of money and pricing, like how do you understand this? And it was just so inaccessible to me at that point. And then we launched these ETFs and we started launching more where you can actually segment, as you say, the money market portion of fixed income or the long duration portion of fixed income. And you can actually make these calls where I was like, wow, this is a big innovation. And you've seen like institutions up them like crazy because just the efficiency that they bring to a portfolio is, I don't know why anybody buys individual bonds anymore.
Yeah. I definitely, just from all the interviews I've done, I don't think I've ever run across someone that's like, you should just buy individual bonds. It's not really a thing.
Your institution, I think it's really hard to do. Yeah,
exactly. Yeah, like for the DIY investor, I've heard some people say, oh, maybe I'll do this, I'll consider it. But then I have yet to talk to someone where they're like, oh yeah, I just decided to buy individual ones over ETF. It's I would say relatively rare. Yeah, I do want to point out on this topic of fixed income and the different types of fixed income that exist and how people can pick and choose. You did a really great episode with Matt Montemurro, who we've had on the show before as well, over on your podcast, the ETF Market Insights podcast. Very recently, I watched that whole thing. It was really good. I'll be sure to link out to it. But for anybody listening, if you Google ETF Market Insights and you look for Matt Montemurro, it's about that whole fixed income, and he goes into the different ones that are available and how some of them are different. It's actually pretty straightforward, but just to get an understanding of what the different options are. But I figured today we can do a little primer on that as well, just for those. And again, I don't want to overwhelm the beginner investor because imagine for someone just getting started, just picking a single asset allocation ETF is sufficient for them. But I do feel like people in my situation, for example, where we are actually living off our portfolio, we are actually looking to make all this work in terms of selling some investments to pay for groceries and property tax. You start thinking a lot more about, okay, how much is actually really not going to fluctuate because I do need to pay for the credit card bill next month. Yeah. And so it's something worth having in your toolbox and experience. So we'll get into that. All right. So moving on to the next question related to this topic. Once an investor reaches financial independence and is ready to transition to either a full retirement or a semi-retirement, I've noticed that a shift occurs when it's no longer just about how much we can psychologically handle the declines, but it's about the cash flow that we have available now that we are living off our portfolio. So what I just mentioned. So again, to give you a real life example, now that we're at that stage of our lives where we are living off our portfolio, I personally feel uneasy about having nothing in that fixed income bucket, because I don't want to sell any of my equities to buy groceries, let's say, when the markets are down 40%, for example. And so one way that I've started thinking about asset allocation in retirement or semi-retirement in my case is to think of that fixed income bucket as the cash reserves that I have ready to deploy when the markets take a major hit. And so I can essentially sell a portion of those to pay the bills so that I don't have to sell any equities when they are down. And so what I've personally been doing is holding something like a ZEQT or its underlying ETFs or its equivalent for that stock portion of my portfolio, but then picking a fixed income ETF that I feel comfortable with for that safer, less volatile portion of the portfolio. And so the one that I'm using right now that I've pretty much settled on for now is ZST, which is the ultra short-term bond ETF. And then the other one that's pretty much at the top of my list, if I want something a bit less risky, a bit more less risky, something even less riskier, is ZMMK, which is the money market fund. And that's actually the one that I've been using with my parents. They're also retired, so they're looking for definitely having a portion where they know that's going to be fine. But I do realize that there are many other types of bond ETFs out there. And I find myself wondering if maybe there is one that is an even better fit for me. For example, should I go, like I said before, short-term or medium-term bond? Can you give us a bit of a primer on what some of the other major ETF options are in this fixed income bucket and how differently they behave in the different environments, just so that we can pick a better one for us, for anybody that's interested in this?
I think you nailed the first bucket, which is really the cash alternative or the reserve pool bucket, which is made up of any ETF that's really ultra short term. So you mentioned ZST, low duration, it's going to generate a modest yield, minimal interest rate risk, good for liquidity. And then ZMMK, which is just, there's been so much money going into ZMMK. It's a $5 billion fund now, especially in the DIY channel. We're seeing a lot of money flowing into this. Again, really ideal for cash-like reserves. And we saw that trend. Everybody was buying HISA ETFs at one point, and then there was some regulation changes. The HISA ETF yields dropped, and then we saw this flow going into other types of ultra short-term bonds. So I think if you're looking at it as a cash reserve portion of your portfolio, that ultra short-term bond / money market bucket is the right spot. Short-term bond ETFs, a little bit up the risk ladder. At BMO, we have short corporate, short federal, and short provincial. So we really slice and dice the market for you. So you're going to get slightly higher yield than an ultra short or a money market ETF. Still relatively low duration and risk. And I'd say this is like your average conservative income generating client that would be looking for something like this. And you get into the medium term. So again, we have mid-corporate, mid-federal, mid-provincials, more yield potential, moderate interest rate sensitivity, fits well and balanced. Your average balanced portfolio allows some growth or to get that growth and income focus. And then I'd say long bonds are really your higher yield play, but they are very sensitive to interest rate change, a little bit more risk on the table there. And then last, but certainly not least, ZAG, our BMO aggregate bond ETF, which really is just that broad-based exposure. It's our largest fixed income ETF, giving you exposure across the curve. And I think this is a great fixed income ETF for a lot of investors who don't really want to make a call on fixed income and the yield curve and where they want to be and what's going to happen with interest rates. They just want to have a fixed income portion of their portfolio. We see a lot of investors using ZAG. That's, in a nutshell, the fixed income ETF segments.
Awesome. And one thing I want to point out that I think would be helpful for anybody listening here in Canada that has corporation, because I know this is like a small segment probably of the listeners listening, but I think it's an important one. Or maybe they know someone that has their own company and a corporation. Because a lot of times I find with the corporate accounts, if you have a business, you might have a whole bunch of cash just sitting in your corporate checking account. And you don't really want to invest it in equities, let's say, because you want some cash flow for your employees, or you've got your tax installments coming up, things of that nature. And so they're just sitting there earning probably close to 0% in terms of interest. And so one thing that I think can be helpful for Canadians in this situation is, in those cases, you could have a corporate investing account and you basically take that cash that you know is going to be, basically you don't want it to be volatile, but you also don't want it earning 0% in your checking account. And so you could use that money to basically buy one of these ETFs, like in my case, like ZMMK or ZST, something that is not going to fluctuate very much, has a good yield. And then you're actually getting some interest versus the zero you're getting in the checking account. And then that money is still relatively safe compared to like equities, let's say, that could fluctuate a lot. So then when you do need to pay, let's say, that tax installment or whatever the case may be, or you can just pretty much sell that, put it back in your checking account, and spend that money. So I think that's a good strategy, I think, for business owners, because I know quite a few of them, and sometimes they're sitting on like tens and tens of thousands of dollars, but different businesses go in different cycles and they know, okay, winter is coming where we're going to get less sales, but I don't want the money just sitting there doing nothing, but I also can't invest it aggressively because that's way too risky. So here's another option. So anyways, just want to quickly point that out, just something to think about, something I wish I knew when I was first getting started. So Aaron, I also want to get your take on this because so it's funny because like right now I'm pretty much around 98% equities in my own portfolio. So we got around 2% in that fixed income bucket. But what's funny is that I probably spend 90% of my time thinking about the fixed income piece and barely any thinking about the equity piece, because to me, the equity piece has been solved. It's like you've got things like I mentioned, the ZEQT, things of that nature, where it's okay, we're just buying the stock market as a whole, international diversification, whether you're buying the asset allocation ETF or the underlying. To me, it's been solved. So I don't have to keep rethinking and questioning myself anymore. But what I constantly am questioning myself about is that little bit of fixed income.
Keeping
which is silly, right? It's like the 80-20 rule, and I'm doing the opposite because that's the part that in my brain is still not solved, right? Do I go short term? Do I do money market? That kind of a thing. Yeah. So I want to run by you the way I've been thinking about it, because hoping it's helpful to some listeners who maybe, I'm sure there's others that are going through the same thing, but it'd be great to get your opinion because you actually know these really in depth. So the way that I've settled on, like I said, I settled on ZST for now and easily swapping to ZMMK as an alternative as well. But what I did is I basically took the different bond ETFs that you mentioned that you have, like the different durations, and I went into Morningstar Canada and I pulled each one of them up. And I like Morningstar Canada. I've mentioned this on the show before because it gives you the total return. So basically any growth or declines plus the income, like in the dividends, right? Because you never want to just look at whether the investment went up and down. You also want to factor in any income that it generated as well. So I'm getting a good total return for each one. And then I basically looked at it year by year. So if you scroll down, you can see like for each year, what were their returns? And then I looked at, okay, this is supposed to be for the safe portion of my portfolio to pay for the kids' shoes or grocery to feed the children kind of thing. And so I don't want this to be negative. And so I basically look at each of these and say, okay, when times were bad for bonds in general, how much did that particular ETF drop when the bond market was getting hammered? And then so you look at that. And then I would also look at what kind of yield is this generating now. So I would look at TTM, the trailing 12-month yield, to see, okay, based on the past year, what kind of yield would I have gotten? And then in this sort of, I wouldn't say worst case scenario, but a pretty bad case scenario when 2022 happened, what was like the really bad hit that happened in the bond market? And then based on those two factors, like I said, I settled on kind of my final list essentially to say, okay, here's what I'm willing to receive in terms of yield. And I know that, okay, worst case scenario, I'm still going to I'm not going to have to set at a loss to buy groceries. So that's how I approached it. What do you think of that approach? Any sort of flaws that you see in it? Yeah, just give me your opinion, because I was trying to find like a good structure to think about it in a somewhat methodical way.
I think you're pretty clear with your goals for this portion of your portfolio being like, you don't want fluctuations. You want this to be steady Eddie. So I think that was a good way of doing it.
Okay.
I think that's probably the easiest need to solve in the fixed income market, because if you're looking for higher yield and you're doing that exercise, there's other factors that are going to be at play. But for you, I think that makes sense. Look at the total return over every calendar year and just say, can I handle this? And that is what that fixed income portion means to you. And you've solved for that, Cornell. You should just be able to sleep by now, I think.
Maybe I've got some like obsessive compulsive tendencies or something. For some reason, specifically about fixed income. So I guess I'm in the right field.
You got to deal with this. Yeah.
That's funny. Okay. Well, thanks for, I see what you're saying. Yeah. Like if somebody is looking for some more yield, but there's all this sort of in-betweens that you can pick. In my case, I basically designated as this fixed income piece as, okay, this is like short-term grocery money, property tax, car insurance, vacations we're taking this year, that kind of a thing. And so for me, I don't want this fluctuating, like specifically for non-discretionary expenses, especially. Yeah. And so for me, that kind of became easy because when the argument comes up of, but you could be getting more yield, I don't really care about yield all that much, or return in this case. because that's what my equities are for, is for the growth, right? This other part is for not having to sell my equities when they're down 40% because we have another 2008 happen on our hands. So that's been my thought process.
Yeah.
But okay, thank you for your opinion. Yeah, I was just want to see if there's any glaring.
Not a financial advisor. Where's my
yeah. But of course, yeah. But just if anything kind of jumped out as, because there's a lot and it can be overwhelming, and so at least this way I thought, okay, what's like a structured way, and then obviously it's going to be different from person to person. So thank you. I want to quickly ask you about ZEQT in particular, because I do own a fair bit of it, like I said, myself. And I have noticed when tracking its performance that it does sometimes behave a little bit differently than its competing ETFs, like from iShares, for example. And we see this among the other competitors, like with BMO, iShares, Vanguard. They're all tracking the total market, but there's still some differences between the three of them. So for instance, like when I look at like iShares versus BMO, on some days, let's say ZEQT in this example, it might be slightly up, while all shares is slightly down, or vice versa. And it's never by a lot because they're all tracking essentially the same thing with some variations. But I can see some investors wondering why there is a difference when both are trying to buy the stock market as a whole. And so far I've been assuming it has mostly to do with just slightly different weights that they're using, like how much Vanguard decides to put into US versus BMO. But can you maybe explain that a little bit, just for anybody that gets a bit nervous seeing some of these slight differences between the different providers?
Yeah, I think, basically they're all going to use their own underlying ETFs, which means that their own broad US based, broad Canada, broad international ETFs are going to, in some cases, track different indexes. Different indexes have different rebalancing rules, different sector constraints, different things within geographical regions, perhaps. So all of that is going to go into it, and that's going to lead to minor performance variations, especially if you're looking on a daily basis. Another thing that can impact it is timing of rebalances, which I think I mentioned, but also flows into the ETF and getting those invested. There's such thing as a cash drag, but that could happen. Tracking error could be an issue if those underlying ETFs are not tracking their index as closely as others. That could lead to a difference. Fees, we're lower now, so hopefully that'll start to show even more in the performance as we go. But yeah, and then different weights too. It's about the underlying holdings and the indexes that they're tracking. And I think that's why it's important to go that level deeper and look at the underlying and look at the indexes they're tracking. Are they tracking the major indexes, S&P, MSCI? Or are they no-name indexes that may not have been around for as long? Something to consider if you want to really go deep.
And now a quick message from one of our sponsors. There are so many opinions on how to invest your money today, but it can be hard to find credible voices to rely on in the world of finance and investing. One resource I turn to every week is the ETF Market Insights YouTube channel, led by today's episode sponsor, BMO ETFs. Market Insights brings in industry experts, and their weekly episodes cover the hottest themes like inflation, infrastructure, healthcare, and more. Tuning in helps me stay up to date on what's happening so I can be a smarter investor. And you can also submit your own ETF questions to be answered on the show. So do yourself a favor and subscribe on YouTube to ETF Market Insights, or visit etfmarketinsights.com so you can be notified when future episodes go live. Okay, great. And while we're on the subject of what is inside these asset allocation ETFs, during our interview prep, you mentioned the importance of doing your due diligence to understand what ETFs you are considering buying actually hold. Can you speak to this along with some good practical ways that we can do this due diligence ourselves?
Yeah, I'm a big advocate of just going to the ETF issuer's website and bringing out all the regulatory documents, the ETF fact sheet, the prospectus, looking at the holdings tab. You can use any number of ETF screening tools. You mentioned Morningstar, TMX Money. BMO ETFs has a really good comparison or screener tool that you can compare side to side against any Canadian listed ETF. But I would say make sure you're looking at the performance, consider the volatility. And then really importantly, I think when we're dealing with something like this, look at the fee, because that's going to make a difference over time. And we recently reduced our fees, and I think that's going to be a big attractor for people who are looking for the lowest cost approach they can possibly get. I mentioned looking at the indexes, so I won't repeat that, but I do think having those known benchmarks is important. And yeah, just make sure you're doing your homework on the website, really.
Awesome. Yeah, last I checked when you guys did the rate cut, at least at the time of this record, or like the last time I checked, basically, you guys were still the lowest compared to the other major providers. So that was awesome to see. So obviously things can change over time, but for me, it was very easy because I put money into our RESP. And so for that one, it was like, okay, well, which asset allocation ETF do I put in there? Okay, well, BMO's currently got the lowest price in terms of MER, and you guys are Canadian, whereas the other two providers are American. So for me personally, it was a no-brainer. But I think it's something good to think about, especially if Vanguard comes to mind, because I know they get a lot of very positive PR from different bloggers in the US, that kind of thing. But I think it's important, like with us Canadians, things are a little bit different for us. Like I did notice that some other fees on some other ETFs are higher than iShares and BMO, for example. So again, I'm not trying to speak ill of anyone. It's just, all I'm trying to say is to basically do your due diligence, do check the fees. Don't just assume that, okay, I read this blog from some US blogger, they recommended this ETF, and therefore I should buy that one as a Canadian. Things can be can be different. The fees can be different here for us in Canada when you're buying a Canadian version, right, on the Toronto Stock Exchange. Just something, again, like Aaron said, when you're doing your due diligence, that is something that you do want to obviously look at, is the fees. Okay, so that's great. What do DIY investors need to know when it comes to stock splits? I know you guys recently had one. Is a first, maybe if you can define what it is for anybody new to all this, but is a stock split for an ETF different than a stock split that we would typically see for an individual company?
Not really, in a nutshell. We recently did the stock splits on our asset allocation ETFs because we were reading a lot in social media and Reddit that this is something investors were looking for, just like a lower cost entry point, because there's really no impact at the end of the day to investors in terms of the value of their investment. We thought, let's make this more accessible for investors. So we did a 3-for-1 split. So I think our NAVs were somewhere around 50, give or take. So they're going to come down to 15, 16-ish. And investors basically will just get more units of the ETF that they're holding. We saw the fractional share trend on online brokers. Some are doing it, and in that case, maybe a lower NAV isn't a big deal, but some don't have fractional shares. We did this just to really provide Canadians better accessibility to it. So for every 1 unit they have, they're going to get an additional 2 units, and then their price will come down to reflect that as well. But yeah, it's just about listening to Canadian investors in terms of what they want, making it more accessible, making it a little bit more flexible in terms of rebalancing portfolios.
That makes sense, yeah.
That happened on August 15th. So it's relatively new.
Awesome. Yeah, and for anybody new to this, I think a common example I see is for something like Amazon, how the price has gone up so significantly, right? Or Tesla, I guess, would be another one, right? I don't know where they are today.
Yeah.
Where you've got this company that started off with a low price per stock, and then eventually it's $1,000 a share, and now it's like someone wants to buy the company, but they don't have $1,000 to invest, and so that's why these companies, they'll do these stock splits. Or I guess one of the reasons, right, is okay, now instead of $1,000, let's make it 500 or maybe even 100 or something like that, so that more people can get in and buy the company. But the existing people that already owned it at that other price, it's not like they lose. They just now have more units of that particular stock, or in this case, an ETF. So it's definitely not something it's definitely not a bad thing. In fact, it's like typically it's seen, I think, as a good signal, isn't it, Aaron? Because it basically means the price has been going up.
Yeah.
And you know what I mean?
Stock, yeah. Usually we weren't up to $1,000 per unit.
Yeah.
But
that's an extreme example, but yeah. Yeah. Did I explain that correctly, Aaron, based on your understanding with stock splits?
Yeah, it's all about accessibility. And yeah, it's interesting because some investors think like the higher price the stock, the better it is, right? And I don't think that's a really good way of looking at it. And so I think as long as investors understand that just because it's not $300 doesn't mean it's not a high value stock, or in this case, ETF. It's really just, we can set the NAV at anything we want. When we launch an ETF, we choose a number. We say, let's make this one $20. So it's really just a number. And then the amount of units you have is going to depend on how much you can buy. No,
right, yeah, because it's the value divided by how many units, and then you can choose how many units you want to issue. So
yeah.
That makes sense. Yeah, and you know what? This is a real thing. I was helping a family member the other day with this, And that was actually a question they asked me, which I've never gone before. They were like, oh, but this ETF, yeah, these are both total market index ETFs, but this one is higher. So doesn't that mean it's better? And they're just thinking, okay, from their stock trading days, they just thought, okay, the higher the price, then it must be because it's doing better. And so it's grown to that higher amount. But like you said, it really depends how many units is that divided by.
Or how many stock splits have they had in history and that type of thing. Like, it's hard to tell. Yeah.
Exactly. Yeah. So I guess the same with ETFs. Yeah. So I think that might be, I've seen, again, this family member make this mistake. So I think it's perhaps a mistake that some beginner investors might make where they base their decision partially based on that, whereas actually it's not really relevant because, like you said, it's with the units. So yeah, so thanks for clearing that up. Okay, that's great. Again, thank you so much for coming on. Can you tell us where investors can see more educational resources from you and the team?
Yeah, so we at BMO ETFs have our website for DIY investors, which is etfmarketinsights.com. And on there, you'll find all of our investor-friendly materials and educational resources, links to the tools that I've mentioned, a link to sign up to our newsletter. We send out a weekly newsletter. And then we also do a weekly YouTube series. So every Friday, we release a new video on a whole wide range of topics. And then we also have a podcast called Views from the Desk. So you'll find it all at etfmarketinsights.com. But it really just showcases, like, my whole team's responsibility is providing DIY investors educational resources that's going to help them better navigate all the noise in the market and the increasing number of ETFs. So I hope everybody finds that useful.
Awesome. Thanks so much, Sharon. I'll be sure to link out to those as well. I already have been, but I'll keep doing it. So thanks again for your continued emphasis on educating Canadians on all this. You're providing education so we can make better decisions for ourselves. So I know for me, I definitely appreciate that. And it's so great to pick your brain on all this since you actually know the inner workings and you've got a whole team in place and that can help answer some of these tougher questions about ETFs and how we can use them for our portfolio. As always, thanks so much for letting me pick your brain. Hopefully now I won't be spending so much time thinking about my fixed income thing. All right. Thanks, Aaron. Bye. All right. I hope you enjoyed the episode. Please share it with someone that you think may find it useful. And of course, leaving a review on Apple Podcasts or Spotify is always super appreciated as well.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.